This week on the Retirement Quick Tips podcast, I'm talking about navigating markets in turmoil. Today, I'm asking a question that definitely needs to be answered. You want to ask yourself this question. I think it's scary what's going on right now in the markets. You've seen your portfolio drop, in some cases, losing hundreds of thousands of dollars in just a matter of weeks, depending on your portfolio size. And if you're really close to retirement, that's a really scary thing to see. You want to ask yourself, can my portfolio handle a bear market? Now, generally, we don't want to go into this catastrophizing the situation because many people will look back to the financial crisis of 2008 and the stock market losses of 50% during that time and say, I cannot go through that again. I'm 15 years older now. I'm closer to retirement. Maybe you've already retired. And so they look to 2008 or maybe what happened in the dot-com bubble and see the magnitude of losses in the stock market at that time and say, no. I cannot go through that again. I cannot handle the volatility and the years crawling out of that hole, especially if I'm retired or withdrawing money from my investments. So there's a couple of things that I think are important to talk about, recognize, and think about. One is the likelihood of a bear market. Do these happen? Do you have big drops, 30, 40, 50% in the stock market? Yes. How often do they happen? Not that often, but it's unpredictable. And chances are sometime either around retirement age or in retirement, you're going to have one of these 2008 type market events because even though history doesn't repeat, it does rhyme. And the market tends to be very volatile and react very sharply. And there's always a new crisis that comes along seemingly out of the blue that will plunge the market into a deep, dark recession and a bad bear market that takes 3, 4, 5, 6, 7 years or longer potentially to crawl out of. So the very first thing you want to keep in mind here with can I handle a bear market is if you're close to retirement and you're still very aggressively invested, which many of you listening are, I talk to people all the time and I'm shocked to see that they're 70, 80, 90% in stocks still, and they're very close to retirement. Maybe they're already retired. Some people have the constitution for that. They can handle it. They don't mind it. If you have enough buffer in your finances, you may be able to get away with that and be just fine, while also recognizing that if we do have a big bear market or another '08 type event, that you're going to spend 5, 7, 10 years just getting back to even. And that's exacerbated by the fact that if you're taking withdrawals from your portfolio, it will take even longer. Some portfolios never recover because the combination of the downturn, the losses, and the withdrawals on top of that, you look at the portfolio value pre-crisis and post-crisis, and it's very possible that you never get back to even. Now, I'm painting this picture if you are very aggressively invested. It's much more likely that you're going to crawl out of that hole and recover and be just fine if you are more balanced in your investment strategy. If you have 60% or 50% or 40% in stocks. This is why most advisors or most financial planning, the powers that be, will recommend a balanced portfolio because it provides that growth, but it also provides the all-important protection in a down market. So you do have a chance of recovering from that. I would say that if you are aggressively invested, I don't know where the market is going to be or where your portfolio is right now when you're listening to this episode. But with the volatility, we've had some reprieve. We just had the third best day as I record this on April 9th, the third best day in the S&P 500 ever. But you know what's interesting? The number 1 and number 2 spot, the best day in the S&P 500 ever, it jumped 11.6% in one day, October 13th, 2008. In the midst of the financial crisis. The second best day was like 2 weeks later, October 28th, 2008, almost an 11% gain. But we all know what happens because what tends to happen in these bear markets is you do have opportunities where you can reevaluate your risk and potentially make some changes. And I think if you are overweight in stocks right now and this has really spooked you and you're very close to retirement or already retired, we've had a reprieve. You don't want to sell into the teeth of a downturn, but you have this wild swing in both directions. And that's what characterizes bear markets and downturns and that intense volatility. That can help you too, because it gives you an opportunity to reevaluate, maybe shift some things around, even making some changes on the margins, like decreasing your percentage in stocks by 5 or 10%. That can help. And if you do that on a day like we just had, where the Dow is up like 3,000 points in one day, then those are where the opportunities come. So the best days are often in the midst of the worst and most volatile markets. That's true of the tech bubble, the great financial crisis. It was true during COVID as well. And it's obviously true right now in this intense volatility that we've had, where we had the third best day ever. So can you handle a bear market? It's a very important question to ask yourself and to evaluate where you can make some tweaks and some changes to lower your risk. Because if we are headed for a recession, tariffs aside, there's reason to believe that the economy is slowing down regardless. And there are cracks appearing. The U.S. Conference Board, U.S. Economic Outlook is predicting below trend economic growth for 2025. And that was before tariffs. So if tariffs play out in sort of a more pessimistic scenario, you could have GDP decline and we could go into a recession, and you could see the market turmoil continue and last for quite a long time. So again, tariff policy continues to evolve. It's very early, too early to determine if the economy will tip over into a recession, but you need to make sure that your portfolio is protected. You have some downside protection in the form of cash and bonds and other safe haven assets. And we've seen how quickly sentiment can shift. So we want to prepare ahead of time by having proper asset allocation and diversification and a focus on quality. And if you are panicking a little bit because you've sort of let things run their course and you have 80, 90% in stocks and you're like 2 years from retirement, then take this volatility on the upside too to make some changes and some shifts to reallocate if appropriate. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.